Okay, Stephanie, let's see if I can get you in a room. Yay, I can. Okay, let's see. All right, you're going to go into room 3. Last thing I want to do is put you in the wrong room. All right, you should be able to get in now.
Okay, I did download this time. I don't know if that makes a difference, just for reference. Okay, great. Thank you.
Thank you. Okay, did you guys have enough time? Let's see, is everybody back? We got 7 back. Corey, did you guys have enough time to finish it?
I accidentally hit the button before I had a chance to talk about it. I just saw it pop up and I hit the button mindlessly. So
okay. All right, hopefully everybody's coming right back in just a second.
Oh, we're back.
Okay, good. All right. So if we look at problem 7 in chapter 6, first thing we're going to do is we're going to common size our balance sheet. And when we look at the balance sheet, we can see that total liabilities and equity or total assets are 33,000. So you're going to divide every one of the accounts by 33,000. When you do that, you get these numbers over here. This is your common sizing. Everybody good with those numbers? Those percentages?
Mm-hmm.
Easiest way to do is in Excel, and in Excel, you just are going to drag down the column and divide everything by 33,000. Okay, there's 2 quick questions here. Let's see. How much cash do they have on hand relative to their total assets? James, how much cash do they have as a percentage of assets?
Jack and James Barry, right? Me?
Of course, you're their only James in
Sorry.
here.
It's 1.52, right?
That's right. And what about short-term and long-term debt as a percentage? Stephanie, since you had so much time to work on it.
Do you know
I actually didn't have any time to work on it because my computer force rebooted. Can I get a pass on this one?
You've got to pass.
doing the screen?
Yeah.
James, but not everybody's looking at the screen so carefully.
Oh, sorry.
All right, James, so what's the short-term and long-term portions?
Oh, sorry. It's the total at 63.64%.
Good. And so we're looking at 20.61 for short-term debt, and long-term debt is 21.21. So the total liabilities, but keep in mind that includes your accounts payable. Total liabilities is 63.64. All right, the next questions are asking about the income statement. And so for the income statement, we're just going to get rid of my drawing tool. For the income statement, or sorry, for the income statement, we're dividing everything by the revenues of 30,000 to get our percentages. And what we want to know is, what do they have left over after paying all of their expenses as a percentage of the total? Mark?
Yes, ma'am.
So
after they get all done paying all their expenditures, they have a net income of 2.3% of revenue.
Perfect. Okay. All right. And what do you think about their percentages, like cost of goods sold, operating expenses? What kind of company do you think this is, given these percentages?
It's probably like they're a clothing company.
Why clothing?
Or some kind of manufacturing.
Yeah, just some type of manufacturing. I agree with that.
Good.
Or, I don't know. I just was thinking of clothing. Just manufacturing of clothes being high and then selling like Under Armour, for example.
Good.
I would have said maybe a grocer, but I think their short-term debt would have been higher.
Yeah, I was thinking that about groceries as well. And I also think those gross profit margins are too high. They're in the grocery industry, their margins are even smaller than that. But it's got to be some kind of manufacturing because those cost of goods sold are really very, very high relative to revenues. It certainly isn't a premium priced business. If it's software or something like that, it's really tight margins for gross profit. Okay, good. Any questions on this problem and how to create a common size statement? So once you pull the data, for most of you, I would tell you to pull, and we'll do some of that tonight, I would tell you to pull 5 years of historic data for your company. Now, for those that have the company that's only been public for less than 2 years, you're not going to have 5 years worth of data. But go back about 5 years typically, unless you've only been public for a couple of years, and common size the statements. And then we'll see how we also pull competitor data to do a little bit of a comparison.
Professor, I have a question.
Yeah.
So when you're trying to do a common size balance sheet or income statement, the reason you do that is to compare it to other competitors in the industry?
And compare it to yourself over time. So if we had this company and we had 2 or 3 or 4 years worth of data, we could see if they're maintaining their cost of goods sold percentage. If it's 66.67 and next year it drifts up to 68%, the next year it drifts up to 71%, why are they not controlling their costs better? So do they have a problem that their margins are getting squeezed because they've got competitors that are keeping their prices down? Are they not managing their raw materials well? So it lets you look at your company as well over time, as well as comparing it to others.
Okay, thanks.
Okay, sure. Okay, and hold on to this problem because we're going to reference it when we do a couple of other problems. And when we do those other problems, I'll give you the correct problem number so that it's a little bit easier to do the first time through. All right, the next thing we're going to do is statement of cash flows. And if you had me for 703, you know that I really push on cash flow statements, understanding them. Now, this book will tell you when you're doing evaluation, do a cash flow statement. I don't typically, but I think reading the cash flow statements that exist are helpful in helping you understand what's going on with the company and how their operations are going. So the cash flow statement is, unlike the balance sheet and income statement that are standardized across industries, the statement of cash flow is not terribly standardized. So you can see some things that are done a little bit differently. But in general, the statement of cash flow has what's happening from operations, what's happening from investing and financing. Ordinarily, we would expect the cash flow from operations to be positive. That says, as you produce your product, you're making money. You're generating cash and producing your product. It's hard to survive long term if your cash flow from operations is negative. That said, we'll see in a minute what goes into creating a cash flow statement. And so when companies are in really high growth, it's not unusual for cash flow from operations to be negative for a period of time. And if you think about it, what goes into your operations are those net working capital accounts. And when you're growing really quickly, you may be extending more credit. You may be building up your inventories. So short-term periods of negative cash flow from cash flow from operations isn't unusual, but longer term, it's a problem. Tesla's one that it's negative pretty routinely. A lot of growth, but they've got to stabilize at some point. Now, investing says, what are you buying to generate your cash flow? So what kind of fixed assets are you buying? Typically, that's a use of cash. Typically, that's an outflow. But sometimes you sell off a division, so it's possible it could be positive. But ordinarily, that's an outflow. And then financing activity could be either. If you've borrowed more money to finance some fixed assets, that's going to be a source of cash. You've got debt you got to pay back later, but in this period, it would be a source of cash. Sometimes you pay down your debt. Sometimes you repurchase stock. So financing really can go either way. It could be a source or a use of cash. Ordinarily, operating activities is a source. Investing ordinarily is a use. And then financing could be either way. All right, so let's take a look at this statement. And I want you to take a couple of minutes to look at, this is the company that's in the book, Better Buys. Look at their cash flow, and you'll see the 3 real categories I want you to focus on. So look at these cash flow from operations, look at them through time, see how they're doing, and then see what up in here is causing these numbers to shift. And then look at your cash flow from investing, and then look at your cash flow from financing. Take a minute, and then let's talk about what you see with this cash flow statement. All right, who wants to talk about the cash flow statement? You can raise your hands or I'll call on somebody. Seeing a dearth of raised hands. John Finnegan, you're up. What do you see? Up, you got to turn your mic on.
Oh, all right.
That's better.
I mean,
Cash
a
flow,
couple.
cash flow provided by operations is moving up steadily
Okay.
from 11 up 7.5%, and then just short of that again. So you have a steady increase.
Okay.
The cash flows from the investing activities is going the other way. So I'd question, which investments they're in,
Okay.
and the cash flows from the financing activities have improved. Were steady really for the first 2 years, and then have improved dramatically.
Okay. And what's driving those cash flows from financing?
I'm not really sure.
Short-term debt.
Short-term debt, long-term liabilities.
All right, Christine, what are you seeing with short-term debt? What are they doing? Source or use of short-term debt?
So it's an increase in it's an increase in short-term debt.
Is that a source or a use, Christine?
So that's
Source.
increasing in liabilities. That will be source.
Yes. So you're borrowing more money on a short-term basis, and so that's one of the sources of cash for them from financing activities. Anybody
Yes.
else want to break out anything else within the cash flow statement that is noteworthy?
Yeah.
They invested a lot in inventory in 2012. That seems to have had an effect on that year particularly.
Yeah, look at this. Look at these inventory numbers right here, particularly. That's a big chunk of cash that they invested that year. We would certainly, that's what I would do on a cash flow statement I saw from this company, say, okay, so what's going on here? It's interesting because net income is pretty stable and actually declined here. That could have been expense driven, but odd that we're seeing that giant increase in inventories. And also, we see depreciation going up steadily, which is not surprising given that they continue to invest in fixed assets. So we would expect that number to increase steadily. They had this. Go ahead. Anybody else?
Yeah. Their accounts receivable, if I'm hearing it correctly, they're from 2012 to 2013. I mean, it increased dramatically, right? And their accounts payable decrease as well, but that means that they're lending more credit to consumers, like they're not collecting, so their cash flow could run into problems.
Excellent. That's a use of cash. They're tying money up in accounts receivable.
Yeah,
I want to know why.
But as a percentage of the inventory, because they had so much inventory, it wouldn't be surprising that their receivables went up if they had to sell off all that inventory.
That's fair. Depending on what their turnover rate is, it could be that that's partially driving that very high accounts receivable.
I think the thing that I found interesting is their short-term debt didn't decrease, and yet, they should have sold more. Their payables went down a little bit, but it didn't go enough to cover all that short-term debt. So what are they using the short-term debt for?
Yeah, well, I assume they're you're using short-term debt for this up here because they're not using it for their fixed assets. See, their long-term debt.
Yeah, but then I would have expected it to drop in 2013 when they started working the inventory.
Yeah, there's definitely some areas for concern with this company on what exactly is going on and what their some explanations that I would expect from some of these items. But yeah, good job in taking a look at what we see on this cash flow statement. Anybody else, anything else to add to this one? typically when you see a cash flow statement, the footnotes will give you a little bit more information on why some of these accounts have increased as dramatically as they have. But it's with this company, it's good news. They have positive cash flow from operations and steadily increasing. They are continuing to invest in long-term assets, and they're continuing to pay their dividend through time, and they're doing some additional short-term borrowing to fund some of this growth is the way I would describe this company. All right, now let's take a minute to actually, we're going to go back in those teams. We'll see how that goes. Okay, do you see this problem number? This is chapter 6, problem 9. Let's, I think I got it right this time. I'm going to stick you in your breakout rooms. And this is a problem where you're going to take a few minutes to take a look at a cash flow statement and see what you find. You don't need to calculate anything for this one. Rooms are open. Carrie, did you guys have enough time?
We started working.
Okay.
We got waylaid in a couple of conversations, but.
Oh, okay. Well, I'm going to ask you the first question. So take a look at least that part A.
So cash flow from operations has been increasing steadily through the 4 years.
Hold on, not everybody's back yet. Hold on. We have 6 more seconds before they all come back.
Okay.
All right, they're back. All right, Carrie, get us started on cash flow from operations for the period.
So cash flow from operations has been steadily increasing in the 4 years that are given. I think it's a 35% increase total. And so they are generating positive cash flow from operations. And one of the things that we were just talking about was the deferred taxes item, which isn't a large item percentage-wise, but the question we had is that resulting from the difference in depreciation for tax and accounting purposes, and then as the company pays the taxes, the amount in deferred taxes then decreases? Is that what that's from?
I'm so glad I called on an accountant to ask this question, because you're getting right to what we're going to do next. Yeah, companies keep 2 different books for tax purposes. They keep what the financial statements that you as an investor see have the lowest tax possible. No, I'm sorry, hold on. It has accurate taxes, but what they actually pay is something lower because depreciation schedules allow them to pay less. And so what it does is it generates a deferred tax account that's paid down over time. And when we actually, you'll see on the next slide that when we get to looking at the analysis, when you're analyzing a firm and valuing it, you have to take into consideration that change in that deferred tax account through time. And that's exactly what you're seeing here. You're seeing it be a source and a use depending on what the depreciation schedule says that they can claim versus what they actually have to pay in taxes. That's that difference. Okay, anything else you notice with part A?
Just that changes in working capital increase significantly over the time period.
Good. Okay. So we have working capital is a source of capital for them over time. Declining amounts than last year, but still a source of cash. Good. All right. Lizzie, you want to take part B?
Sure. It looks like over the 4 years, they're continuing to increase their investment expenditures.
Okay. So they're continuing to invest. Okay. And then part C, let's see who else is in here. Stephanie, how about part C?
One of the things that we talked about that stood out a lot looking through all the sections was that the company appears to be changing how they finance their business, buying back stock and issuing debt. which could signal a few things, one being a low interest rate environment, that it's cheaper to finance with debt. That was like one of the biggest things that stuck out.
Okay, good. So if you look at their financing activities, most of what they're doing is being financed by operations. So you can see those large positive numbers from operations, and they're using that as an opportunity to increase their dividend. They are retiring some stock, and then they did take out some new debt in 3 of the 4 years. So they are using some borrowing for that purpose as well. But they are, in general, they're paying down a good bit of, they're repurchasing a good bit of their stock through time. Anybody have any questions about how to interpret a cash flow statement? For your firms, you definitely want to take a look at the cash flow statement. It's just a better picture of what's actually happening within the organization. All right, now, if you remember, we started out by saying cash flow from operations in 703, we said it's EBIT plus depreciation minus taxes. And then we came back here last week or the week before, and we said, well, it's actually EBIT times 1 minus taxes plus depreciation. Now we're going to get a little bit more realistic. We sort of baby step our way into our cash flow numbers. All right, so if we're trying to figure out the firm's cash flow calculations from the direct method, we only want to look at what's happening from operations first. We're going to look at those investments separately, but first we're just looking at operating income. We subtract out the taxes on operating income. So if your tax rate's 40%, take 40% of your net operating income to get your taxes. That'll get your NOPAT number. Then look at your deferred taxes account. We did not look at this previously, but you have to, because the deferred taxes have to be taken into consideration over time. So you're looking at the change from, in this case, let me draw this 16,880. If we had looked at their deferred tax account in 2010 and 2011, we'll see that there was an increase between 2010 and 2011 of 16,880. Then you add back the depreciation. So everything is essentially the same, except you have to take into consideration this deferred tax number. You're going to subtract out your changes in capital expenditure, subtract out your changes in net working capital. Those are assuming those are uses of cash to get to your firm cash flow from operations. Then you take a look at net operating income after tax as well to get to the firm's free cash flow. So that's how we arrive at our cash flow numbers. We want to look at what's happening in operations first, and then we want to look at what's happening in our non-operating assets. For some of you, your companies may have no investments in non-operating activities. So then you're just going to ignore this non-operating income. When you come to firm free cash flow from operations, that will be the entire free cash flows for the company. So I'm going to start with operating income. Take out the taxes on operating income, because we're trying to look at just all of the costs associated with operations. So we want to take out taxes. Remember, we're ignoring interest. We're going to pick that up when we get to our cost of capital. That gets us to our NOPAT number. We have to look at those deferred taxes because they are generated because we're in business through time and we're able to manage our tax burden. So if there's an increase in deferred taxes, that's going to come into play here as a source of cash. Then we add back our depreciation, which is a non-cash expense, subtract out any increases in capital expenditures, subtract out your changes in net working capital to get to your free cash flow from operations. Then you want to look at your net operating income after tax. So whatever the net operating income is on the books, that you're going to do that times 1 minus the tax rate to get to your firm free cash flows. And you'll see later why we split this out this way. Sometimes your cash flow from operations has one cost of capital and your non-operating income has a different cost of capital, a different risk structure. And so if we get in the habit of splitting it out now, it makes it a little bit clearer when we get to some of those final NPV calculations. Anybody have any questions about this slide? This one's really important. This is sort of the sum of how we're going to go about working on our big projects.
I have a question we're talking about free cash flow from operations, but CapEx, isn't that classified as an investing?
Yeah.
Cash
So
flow.
it is, and you're a slide or two ahead of me. It is in a cash flow statement. It's counted as an investing activity. However, when you're looking at valuing your company, you have to have capital expenditures in order to generate cash flow from operations. So for a valuation perspective, your investment in capital expenditures and your investment in working capital are all part of your free cash flow from operations, because you don't need those assets if you weren't running your business. And so it's part of the operations cost here.
Okay, so the term operations as used with free cash flow is both operations and investing on the cash balance, the cash statement.
Yeah, because on the cash flow statement, we have the three categories. When we're doing evaluation, we don't split out the categories. The only thing we split out is non-operating income from operating income.
Okay.
Every expense that is not associated with non-operating income becomes part of free cash flow from operations.
Okay.
Good question. Any other questions on this one?
This is
Jesse.
Stephanie.
Yeah,
I have a
that's okay.
question. This same table that's in the book, table 6.4, includes the indirect method.
Yes. Okay. I think I might have.
We may not be getting into that, but I was just confused. What does the indirect method start with?
Okay, so the direct method says what happens from operations. The indirect method says what happens to our shareholders and our debt holders. Let's look at the costs, the cash flows to them. So what are the cash flows to our debt holders? Well, it's interest expense and repayment of short-term and long-term debt. What's the cash flows to our shareholders? Well, it's repurchase of stock or issuance of new stock and dividends. And so this is the indirect method, and you should arrive at the same solution with the indirect method that you do as the direct method. This would get you a really bad grade on your project, though, because the indirect method doesn't tell you anything about what's happening to the company or operationally what's going on. So it gives you the same answer as cash flow for investors, but what the detail is lost and the thought is lost, especially when you start looking at forecasting out. So when we start doing pro forma statements, you can pretty much put any numbers in here. Whereas if you're looking at operations, you have to go back and look at your working capital accounts as a percentage of your revenues, and your detail and your thought and the value of your analysis is far better if you're doing the direct method. So the indirect method will arrive at the same thing, because this is saying this is essentially your cash flow from assets, and then this is your cash flow to shareholders and debt holders. So what are the cash flows? It's your interest expense times 1 minus the tax rate. So you're taking into consideration the taxes. You want to look at the change in your short-term debt. In this case, if it's increasing, that's a source of cash. Change in your long-term liabilities. This one's decreasing, so that's a use of cash. We paid some dividends. For this company, there was no change in their common stock. They didn't issue shares. They didn't buy back shares. So the free cash flow for investors is 411, which is the same as what you see. Back up one. What you see here. So they do balance out. But the information that you have about what's creating value for the company is so limited in the indirect method. And in the direct method, we can say, okay, what's going on here? We're having really nice positive NOPAT. We've got some tax advantage. We've got some investing here in capital expenditures. We've got some investing in growing our working capital. So there's just much more information in this in the direct method versus the indirect method. So whenever you do valuation, you really use the direct method. The indirect will get you to an answer that you could use, but I think the value, especially when you start doing pro formas, what's your interest expense going to be over time? Well, you better take a look at what your debt levels need to be. And how are you going to know your debt levels? Well, you need to know what your capital expenditures are going to be and your investment in working capital. So it really sort of takes you back to the direct method anyway in forecasting. Now, if you're looking historically, the indirect method will get you to the right answer, but you don't really know why, from an operational standpoint, those numbers came to be. Does that make sense, Stephanie?
Yeah, I was just really confused about the first line, what that meant, what that represented, but now I know that's interest expense. That just threw me off the way it was described. Okay.
Okay.
Thank you.
Interest. Yeah, it should have said interest expense. That would have been a little bit clearer. Anybody else have a questions about direct versus indirect? The only thing I want to see you do for your companies is the direct method. The indirect method just doesn't give you much information except it balances, which it will. Okay, so back to Corey's question about the cash flow statement versus firm free cash flow. It sounds very similar, and they are, except we just answered this a minute ago. So the interest expense is not part of our free cash flow number. We take that into consideration with our weighted average cost of capital. The non-operating income is sourced differently, and then capital expenditures are included in the free cash flow. So we could back these out and tie our free cash flow statement will equate to our cash flow statement. They're just, the purpose is a little bit different, and so the calculations are done a little bit differently, which is why I don't particularly care whether or not you do a cash flow statement for your company. It's of limited use as far as I'm concerned. If you do a direct method of free cash flow from operations, you're going to have all of the information you need about what's going on with the company through time. And it really is nice especially if you're thinking about acquiring another company and you're looking at some synergies over time, you can look through your expectations and see where they seem to be reasonable and where you're concerned that maybe you're being a little aggressive or a little too optimistic. So free cash flow statement, I think, comes in real handy. All right, so what are you going to be doing? The first thing you're going to do when you do a valuation is you want to look historically at your company. So you want to look at their balance sheet, their income statement, and their cash flow statement. I would tell you then you want to common size them. So first thing, you get those historic statements and common size them. I would also tell you at this point, it's important to look at macroeconomic data, and we'll see that in a few minutes, and where we're expecting the economy to go, what your expectations are around competition. Tariffs come into play here depending on your industry. If there's a lot of international competition. So you want to take a look when you're gathering your historic information. You also want to get a picture of expectations going forward. And that's not all perfectly clear. If you're in an industry where you're the only player and you're expecting others to join in to enter the market because the margins are so good, you have to incorporate that expectation into your analysis. If you are heavily dependent on a robust economy for your product and the expectations, we're looking at yield curves and we're expecting that we're heading into a recession, you might want to modify your growth projections. So when we gather historic data, I think it's also important at this point to gather some data on what the economy is going to do. And then you're going to calculate, then you're going to project out into the future your pro forma statements. And how far out do you project? It depends on your industry. Typically, we project 3 to 5 years, no more than 5 years. When I used to do a lot of work in energy, because those power plants lasted for 40 years, and because we had contracts in place, we often projected out 10 years because it was pretty stable cash flows, and it made sense because we had pretty good data out 10 years. That's not true in most industries for most companies. So you ordinarily want to project out for 3 to 5 years. Now, for some companies, they have differential growth. They may be growing, like if you were valuing WeWorks. Okay, so if WeWorks actually does get to go public and you're valuing them, they're on a pretty high growth trajectory right now. So you may say they're growing at 25% for the next 3 years. And then after that, they're going to grow at 12% for the next 5 years. And then after that, they're going to settle down and grow at 2%. It's possible you have multiple growth stages for a company. But for most companies that are pretty stable, you would expect that they're going to grow at a higher rate for the next couple of years, and then they're going to grow at a stable rate longer term. So the projection period is when they're growing at a higher rate, something above 2%. Now, for some of your companies, let's see. John, what's the company you're doing? Let me find my list here. John Reyes, which company are you doing? Oh, you're doing SunTrust. Yeah.
SunTrust, yeah.
Yeah.
Now, I wanted to ask you that. Now, since we have to project 3 years, and with this whole merger, how would that?
Yeah, that's going to be a fun one. It'll be a good project for your team.
So we would have to take into account the merger and all of that, right?
Absolutely. That's going to be a good project because you are going to have to look at the combined company synergies, hopefully, and then the expectations of the combined firm. So when you're looking going back, you may want to look at SunTrust and BB&T. You may want to look at the history of both of those companies and then sort of do a historic combination of them and then try to project forward.
Awesome. All right.
Makes sense. Who's doing, oh, Corey, you're doing Sears. So what kind of growth are you expecting to see for Sears in the next few years?
Not much growth at all. So, just trying to stay afloat is what they seem to be doing.
Yeah, so that'll be an interesting one because you may actually have negative growth from operations, and then you may also look at some selling off, look at the history of what they've been doing with their capital assets and selling them off in order to continue to run the business. So that may be, you may only have one stage and it's negative 4% growth per year. You may not have, or it may be even more negative over time. Once you start looking at the company, you'll have a better sense. But you don't have to have a high growth stage followed by a terminal stage. But most of you will have, that's the structure for most companies. It's something above 2% for the next 3 to 5 years, and then you presume it settles down to something under 2%. Why do I keep saying 2%? Because that's typically what we assume the US economy is going to grow at, is about 2% over time. And you can never grow higher than that for your terminal value. So we're going to start with historic financial statements and macroeconomic data. We're going to common size those statements. We're going to create pro forma statements for the next 3 to 5 years where they're growing at something above 2%. From those pro formas, we're going to convert into cash flow statements. And then we're going to figure out what that terminal value is. And then we're going to discount everything back at a weighted average cost of capital that we'll see how to do later. You know how to do this. We did these in 703. Now your data is just going to be messier because you're actually working with companies. And the beauty is, because you're going to be working in teams, you're going to be able to see how to do this for a variety of types of companies with very different growth rates. Some people are going to have negative earning companies. That's going to be a very different model than some of these others. So we'll start working on them in class a little bit next week. All right, so let's see how we actually do one of these. All right. So step 1 is financial statement analysis. That's creating all your common size statements, keeping in mind that GAAP accounting has some differences, and there's some flexibility in GAAP accounting. It's important that you pull the 10K statements. I'll show you how to do that tonight. Anything that seems strange, you should read the footnotes to the financial statements for your companies to try to understand what their policy is over time. A glaring one is if they change their inventory policy, if they have extraordinary expenses. We want to look and see if that's a one-time extraordinary expense, like John's doing SunTrust and BB&T. There's going to be some merger expense in there, so that's kind of a one-time expense. But if you have a company that has an extraordinary expense of some type every year, you want to understand what those are and whether you're going to assume they're going to continue to have extraordinary expenses. For some companies, extraordinary just isn't extraordinary. It's something unusual that happens every single time. And so you're going to factor that into your valuation because you should expect that's going to continue to happen. All right, let's see. This thing's blocking me. All right, when you construct your pro forma, everything is driven off of your revenue and the growth in your revenue. That is especially the first year's growth. So if you're looking at 2015 through 2019, the most important number you're going to forecast is your growth for 2020. That number will drive everything else, because if you pick a growth rate that's too high, all of your future cash flows are going to be based on a number that's too high. And you'll see so many of your accounts are driven off of your revenue numbers. So we want to be sure that we are really careful about that first year's revenue. And then we use that number to figure out what our pro formas are going to look like for the first 3 to 5 years, and then what our terminal value will be. All right, so the revenue forecast you can do 2 ways. For most of you, you're going to do the top-down approach. You're going to look at macroeconomic data, see how it might impact your revenue numbers going forward, and then use that to help drive your projection. Once you have your revenue numbers, most of the other numbers fall off of those revenue numbers. From the income statement, you saw when we did the common size income statement, virtually everything is as a percentage of revenues, and they vary with revenues. Your cost of goods sold, your taxes, pretty much everything varies with revenues, or they're fixed. Your salaries tend to be fixed. What we'll also see is most of our working capital accounts also vary with revenues. So while we create a common size balance statement, that allows us to see what our assets are historically. But when we actually get to creating pro formas, we typically look at our working capital accounts as a percentage of revenue. And that makes sense because our accounts receivable are going to be driven by our revenue numbers. There's usually a steady percentage of revenues over time, presuming that your accounts receivable turnover is steady over time. So we'll look at many of our balance sheet accounts as a percentage of revenues as well. Now, the bottom-up approach is used most frequently when you are internal to the organization and you can split out the different divisions. Remember not long ago when Apple said, we're no longer going to tell you how many iPhones we sell each year, we're just going to roll that into our Apple overall projection. People who do the bottom-up approach really hated that because they like to be able to say, okay, how's the watch doing relative to the iPhones, relative to the store, the app store and things. And when a company takes away that extra piece of information, it becomes harder to value each of the pieces within an organization. So what we're going to probably do for most of you is the top-down approach. Now, John is an exception because he's doing SunTrust and BB&T. He may value those two somewhat separately and then combine them. But for most of us, we're going to do a top-down approach. All right, so let's take a look. So here we have Better Buys. And so we have their cash flows through 2013 in the book. So now we're projecting out for the next 5 years. And we're assuming that the constant growth rate for revenues is going to be 6%. So each year, if you looked at the 2013 revenue number, this is a 6% increase, and it's continuing to increase by 6%. If we go back and look at the common size income statement, you'll see that cost of goods sold were pretty steady at 64.8%. Let me turn to that in the book so I make sure I see what the number is. Often what you'll see is that number is increasing over time, or it's unstable. Let's say it was 62% and then 65% and then 70% and then 61%. You can take an average, and I really hate averages. I like better when you can see a trend, and if it's an upward moving trend, then you want to assume it's going to continue on that trajectory. But if it's just sort of varying around a common number, it's okay to take an average here. This is where your judgment comes in. And what I'll tell you when you do valuation, you should always go back and then do some scenarios around these numbers. What if it's not 64.8? What if it's 62%? That we're going to expect this company over time is going to manage their margins a little bit better. That's an aggressive assumption, but you could value it looking to see what the difference in the valuation would be if we get better at controlling our margins. But in this case, we're assuming our cost of goods sold are about 65%. For our operating expenses, our fixed expenses, we're looking at no change in them over time. They're staying at a set $2 million. Our variable operating expenses are staying at a stable 16% over time. You'd have to look historically at what they've been, either take an average or assume that that you're projecting a number going forward. Our depreciation expense has been steady at about 10%, so assume it's 10% of your fixed assets. So when you have done your balance sheet and you project it forward on your balance sheet, 10% of that becomes your depreciation expense to get to your net operating income. Non-operating income, this particular case is assuming that non-operating income are stable. Now, for those of you that are doing higher growth companies that are growing like Greg, you're doing Square. I think Square grows through acquisition very frequently. Is that right, Greg? Does that make sense?
That sounds right.
I think they do. I think they've acquired other small companies to fuel their growth. So if that's a trend, you may actually want to say that your non-operating income is going to increase by some percentage over time. You don't have to assume it's going to be stable. Look at what the history has been for your company and whether or not it's something that they invested in early on and now they seem to be liquidating those assets, or if it's increasing over time. It's true for all companies, but for some of these smaller ones, it's particularly true that they've grown through acquisition. Okay, after that, we have our earnings before interest and taxes, and then we subtract out our interest expense, and then we subtract out our taxes to get to our net income. And then we're assuming that our dividends, in this case, we're assuming our dividends are stable through time. You don't have to make that assumption. If the company has been increasing their dividends by some percentage over time, feel free to assume your dividends are increasing. And then here are some of those plug numbers. So we have a net income, and we're paying dividends. The rest of it is retained earnings that's going to go and show up on the balance sheet. It's how our statements tie together. So let's take a look at that now. Now, the balance sheet is a little bit more complex, because what we want to do is, while we do a common size balance sheet, we then want to look at some of these accounts as a percentage of revenues, because they very frequently vary as a percentage of revenue. And when we look at better buys, we see that their cash and marketable securities seem to run at about 2% of revenue. So you go back and look at the revenue forecast and then take it forward by 2% each year to see what your cash account looks like. Our accounts receivable, how do we have accounts receivable? Because we're selling stuff on credit. And so when we look at this company, we can see that it's about 21.4%. So we project that forward. It would be unusual and more work for you than you really need to do, more detail than I think you can adequately expect that you can manage, unless you have some knowledge that something big is going to happen in 2016 in this case that would cause their accounts receivable to change. There's some new tax policy going into play that may cause a change in their accounts receivable. Ordinarily, you simplify these. The more complex the models, the more areas for error. And so you're typically assuming steady state, that your accounts receivable are going to be about the same over time. Same with your inventories. Look and see what your inventories have been as a percentage of revenue, and either take an average, or if there's a trend, up it a little bit, and look at those numbers through time. That gets you to your current assets, your net property, plant, and equipment. Again, why do we have capital assets? We have them to grow our revenues. So we're looking at it as a percentage of revenues. Most companies, now one of the things that you may note, if you were doing Ford Motor Company, Ford can build a plant and they'll have capacity for quite some time. So it may be that you don't need a flat 43%. You may want to say, well, we built a plant in 2013. That's going to give us adequate capacity through 2016. So we're going to have steady property, plant, and equipment through 16. And then we're going to see another big increase in 2017. Knowing your company helps you get better at understanding how to make some of these assumptions. Your investments, in this case, these are the non-operating assets. In this case, we're assuming they're steady. Again, in Greg's case, if Square is growing by increasing their investments, you may want to see that number increase. All right, so then accounts payable, a percentage of revenues. Short-term debt, very frequently a percentage of revenues, because short-term debt should be financing your short-term assets, your growth in accounts receivable, your growth in inventory. So they are going to be at a pretty steady state. Get to your current assets. Now, your long-term debt is typically the number that you factor in after you've done everything else. So we're going to come down here. We're going to have common stock. We're going to assume our common stock is steady. The retained earnings, remember we pulled that from our income statement. So we put that number in. Our deferred income taxes is a steady state at 2%. Well, this account has to balance. So we have to have our assets balance out to our liabilities and equity. The way we make it balance is with our long-term debt. That's the number. What happens to our long-term debt over time will be the balancing number to get our assets equal to our liabilities and equity. Any questions?
Maybe one quick question. So when we common size the balance sheet, we're using typically the total liability and owner's equity, but here when we're forecasting out for the pro forma, we're essentially going back to revenues. Is that, I just want to make sure I have that right.
Yes, that's exactly right. We look at the common size balance sheet as a percentage of total assets, but when we project forward for our free cash flows, almost all of the accounts in the balance sheet are as a percentage of revenues. We look at it as a percentage of assets early on just to see how we look compared to our competitors. So are we using about the same percentage of fixed assets, or is that an area we should be concerned about? Are our inventories stable as a percentage of assets over time, or should we be concerned? So we look backwards as a percentage of assets, but we look forward as a percentage of revenue because they typically vary as a percentage of revenue.
Okay, thanks.
Okay. Any other questions on this statement yet?
Should we assume that common stock is constant?
Well, that depends. It depends on your company and what the company has been doing. If when you read the footnotes to their financial statements, they're in the midst of a share repurchase, you're going to assume that the common stock is declining over time. Very few companies will be issuing new shares. The only ones I would be concerned about would be Sears, just because they're so crummy that they need cash. I would be shocked if they issue new shares because it's at such a low value. But all of those companies that have been public for less than 2 years, they typically have a shelf offering. If they do, that will be listed in their financial statements, probably in a note somewhere. And if they have a shelf offering, you usually have to issue those shares within a set period of time. It's usually within the first 2 years. So it could be they just had a shelf offering, but those are the only companies where you usually see additional equity. Most everybody else, it's either declining or steady over time.
Okay, thanks.
Anybody else? Okay. Let's take a break there because I know this is a lot of stuff. We'll take a break and then we'll come on back and work on some more of these slides, and then we'll head over to paying attention to some financial data. 7:55. Let's come on back at 8:05. 10-minute break. Okay. See you in a few minutes. Okay, let's see what we're doing. Okay, we're ready to start again. All right, so when we're doing some of the forecasting, we can use some of those ratios that we've learned previously. And one of the important ones that we use, two of them that I think are important, the average collection period and then the inventory turnover. The formula to calculate average collection period is the same thing we used previously. So you take accounts receivable and divide by sales over 365, which assumes your accounts receivable are steady state throughout the year. It assumes you sell about the same merchandise every day throughout the year. That's not a completely accurate forecast for some companies. Because the fourth quarter is where most of their sales occur, so they probably have more accounts receivable towards the end of the fiscal year. But when we're looking at an annual financial statement, those differences really aren't going to matter. We make a conservative assumption that all of the cash flows occur at the end of the year. So if your accounts receivables are higher in January because of all your Christmas sales, it's going to even out over the course of the year. So if your average collection period is, say, 41 days, you take that 41 days and times your sales number to figure out what so if it's 41 days, you're turning over about 9 times per year. You multiply that by your sales number to figure out what your accounts receivable should be through time. You can do that, or you don't have to use the ratios. You can look at accounts receivable as a percentage of sales, as we did just on the last slide. Now, the challenge you have with some of these numbers is when we look at things as a percentage of sales, it assumes that what we're doing right now is good. And if your assumption is that you're trying to improve some things over time, you may want to assume that percentage of sales is a limiting factor and you can do better than that. You just have to be a little bit conservative. For your companies, I want you to analyze it as if you were looking to buy that company. So I want you to be on the conservative side. Not that you're trying to sell it and so you're trying to inflate your cash flows. I want you to be thinking as you or somebody analyzing a firm that you're looking to purchase. So I want you to be a little bit more conservative. It's a better way to learn how to do this than inflating your numbers. So while the percentage of sales may not be accurate if your company is not in a very steady state right now, if they have unusual things going on, John, with that merger, he may have some synergies that will lead to some lower inventory levels or accounts receivable levels over time. He may, because of the effects of the merger of SunTrust and BB&T. But for the most part, be conservative and assume you're not going to improve given what somebody is doing internally. Now, you're acquiring a company with an existing management team. You can't presume that they're going to make major.
I can't really hear you.
A lot of input.
Yeah, your mic got softer.
Yeah.
I'm sorry. Did I think?
No.
Try again.
You can hear me okay?
Yes.
Okay.
Yes.
Okay, good, thanks. All right, so now we're looking at converting our pro formas into cash flow statements. And it's the same thing that we did when we looked at the company earlier. We're going to start out with our net income, and then we're going to add in our depreciation. All of these are going to come from your pro forma statements. Look at the change in your accounts receivable. So if it's an increase in accounts receivable, that's a use of cash. Okay, this book does a better job of it than our 703 book in keeping those signs consistent. So if it's an increase in accounts receivable, it's in parentheses, that means it's a use of cash. You have it increase, you're looking at the change from 2013 to 2014, what happened to your inventory account, it's an increase. To get to your change in your accounts payable, look at your deferred taxes account to get to your cash provided by operations. Then you can look at your investing and financing activity. Now the book tells you to do this as step 3. I don't require it. It's interesting to look at and compare your cash flow statement to the way it looked previously, but it is not necessary to do a cash flow statement in order to arrive at a valuation for the company. You have to do a pro forma income statement, you have to do a pro forma balance sheet. You do not have to do a pro forma cash flow statement unless you find this valuable. It really isn't terribly helpful in the valuation process. What is helpful is this next step. Next step is converting your income statement balance sheet into a cash flow forecast. So we're going to do the exact same thing that we did earlier. We want to take our net operating income, subtract out taxes on operating income. So if your tax rate's 40%, you're taking 40% of this 3.9 million to get to this 1.57 million. Okay, so that's going to be calculated. That gets you to NOPAT. Look at the change in your deferred taxes over time. If they increase, that's a source of cash. Add back the depreciation that you calculated in your pro forma. Subtract out the change in your capital expenditures. Remember, for capital expenditures, you're going to look, in this case, you're going to look at your capital expenditures in 2014. Subtract out what they were in 2013, but add back depreciation. Go to all of your working capital accounts and look and see what the change was in your working capital accounts to get this number. If it's increased, come on. If it's increased, that's a use of cash. That gets you your cash flow from operations. Then you have to look at your non-operating income after taxes. So non-operating income will be on your financial statement. For most of you, if you have them, you're going to assume it's steady unless the company tends to be increasing their investments. And then whatever the number is that you're going to see on the balance sheet, you want to multiply that times 1 minus taxes. You want to get it after tax basis to get your free cash flow from investors. I do not require that you do this. Oh, hold on a second. Let me get rid of that. This thing out of here. I do not require you to do the equity free cash flow, so you only have to do this panel A. Panel B is the indirect method, and it's the equity free cash flow. You should arrive at a similar number after you discount by the cost of equity. I just think at this point in valuation, it's confusing. We're going to get into more of that later in the semester. So the only thing I'm looking for from you in the October dates is to do your valuation based on your firm free cash flow. That way we'll be really consistent and everybody will discount by their weighted average cost of capital instead of taking a look at your cost of equities. again, it's direct. It tells you what's going on operationally from the company. The equity method, the indirect method, I don't think it's terribly helpful in terms of how the company is doing and areas where you can look for improvements if you're acquiring this company. All right, after that, we get to the terminal value, and that's the piece I'm going to hold off to next week and spend some more time on those terminal growth rates and how we come up with those growth rates. Just remember, your growth rate should not be greater than the growth rate of the U.S. economy, so it should always be 2% or lower. All right, so when we have calculated all of our cash flows, what we want to get to is our enterprise value in order to figure out what the value is for our equity. So we're going to do the present value of our cash flow from operations plus the value of our non-operating cash flows. That's all the stuff that we just did right here. So this free cash flow available to investors, that's what we're going to have calculated. But we're really going to break it down into the pieces because we may have steady state cash flows for several years and then a terminal value. So we want to look at the present value of our steady state cash flows plus the present value of our terminal value from operations. And then we want to look at the present value of our non-operating income if it's stable for a few years, plus the present value of our terminal value for non-operating income. So those are the four pieces that are going to go into our enterprise value. After we get an enterprise value, we subtract out our debt to get to the value of equity, divided by the number of shares outstanding to get to our stock price. We'll do some of that in class next time. Now, I said earlier, we split out our non-operating income from our operations because sometimes our investments have different risk profiles. In some cases, they're more risky than our operations. In many cases, they're less risky. And so we have to discount at the appropriate rate. Remember back in 703, we talked about within an organization, if you have 4 or 5 different divisions, some of them may be high risk and some may be lower risk. So we have divisional costs of capital. Energy industry is a perfect example. Their regulated business has a lower hurdle rate or cost of capital than any of their market-based businesses. And so to value the company properly, you would need to value the projects in the different divisions using different cost of capital. The same is true with operating income versus non-operating income. It's one of the main reasons we split it out earlier when we're doing our pro formas, is we often have to discount them by different discount rates. And so if we did this problem, we would take these cash flows and discount it to 15%, these cash flows and discount at 15%, and then these cash flows would be discounted at 10%. We would have to put them on the timeline so we make sure that we discount at the appropriate rate. Okay. Oh, yeah, okay, let's do a problem. That's good if I tell you the problem number and tell you the right number too. Wouldn't that be a treat? Isn't it pulling up? Hold on, let me see what this problem number is. Yeah, this is problem 12 we're going to be doing. I'm going to pop you into your breakout room so that you can work on problem 12 together. And it's actually taking some information and putting together a pro forma statement. So try to work on your own a little bit first, and then and then work together in your teams before you come back in together. And let me see if 12.
About how much time?
How much time do you think you need? Any idea? Well, you know what? I'll come into a couple of the breakout rooms and see how you're doing in a few minutes. I want to give you enough time to play with this one a little bit. And this one requires you to look back to your problem 7. It's based on the common size statements you did in problem 7. So I'm opening up your rooms, work for a little bit, and then I'll come in to see how you're doing before I pull you back into the main room.